Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for April 12th, 2014. We've got a market that's in bullish volatile conditions. On an annual basis, using weekly RSI 14, we're in the middle of neutral. Short-term basis, using the 10-day NDX, we're oversold with a score of 2 out of 100. That puts us right near the 10-day low at the close on Friday. That's our definition of a critical state. Ready for sharp rebounds or bigger failure. So a sharp move in either direction is probable here. Looking at the market mosaic, price relative to the 200-day moving average is red bullish at 3.82%, meaning we have less than 2% cushion to sideways markets. The 5-day slope of the 50 decayed a little bit here to yellow neutral at 0.33. ADX got weaker to 16.4, so no trending behavior. ATR percentage ticked up into volatile at 1.14%. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX. The boundary condition is 1.0 between risk on and risk off. It's right at 1.0, so we're technically in risk on conditions. That riskier assets will tend to outperform in these conditions, but we're right on the boundary. When you take that score of 1.00 and compare it to the last 5,000 trading days and find the Z-score, we come up with the risk Z, and that's at minus 0.07. This is the 90-day histogram excuse me, of that indicator. You can see after just a little nudge up into favorable conditions, we've ticked over into negative. The concern here is that with the lower highs, that we may be looking for a lower low and more volatility coming. That would be the normal behavior to expect here, in the same way that we saw a rollover at less than 1 on the Z-score triggered a sharp sell-off here. We could be looking for some more gloom there. The balanced monthly rebalancing, current holdings you see in front of you, that's a pretty timely move into the defensive plays like real estate and treasuries, utilities and healthcare, and real assets like agriculture. And these are the current leaders using the BMR lens for these different trading populations. In ETF2, the theoretical exposure is at 50%. The model portfolio will be at 80%. This is a quick look at those several of those BMR portfolios. Now you can see about half of the market is on cash signals here, meaning that they are less than their 88-day moving average price, including a number of the U.S. Markets, which had been the leaders for really the past 6 to 8 months. Now seeing small caps, tech, the Dow, mid caps, and the large caps all on a cash position. Treasuries and then the commodity-based markets in Australia and U.S. real estate now showing some strength. Interestingly, ILF, Latin America, which had been so horrible for so long, is now among the leading indexes. We'll see if it remains immune to any of this European and U.S. sell-off. Inside the 32 ETF portfolio, again, about half are on cash signals. Defensive plays like ag, utilities, treasuries, and Australia are leading the way. You can see just how powerful Brazil has been while the U.S. has been melting down with a 11.5% gain in the last 3 months. Looking at the ETF Max, coffee, agriculture, blended commodities, natural gas, it's all the real assets that are dominating here. The ones that are in green and then white are things that are showing emerging strength or relatively more recent strength, like Indonesia twice, gold explorers, gold miners, agriculture, and so on. Looking at the market health check, we have the vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets to the upside. The red lines, horizontal, are the uh, support levels that have held in the past, which were once resistance levels till price breached them. And when the market is failing, those become the next price targets on the way down. You can see that we've fallen out of the river, which is the dark blue shaded area, 30 period Bollinger Band plus or minus 1. We've fallen out of the floodplain, which is this lighter blue shaded area, 30 period Bollinger Band plus or minus 2. And now we're out here by the third Bollinger Band out. That's that thick red line. And at 182, we're testing uh, a very serious support that is all that stands between us and sideways conditions right now. You can see the 200 period moving average kind of relentlessly moving north. We've got three regression channels, RAF regression channels marked off here: short, medium, and long term. Short term are the blue. You see sloping downward. The black, basically horizontal and rolling over. And then the long-term green, which is that longer-term bullish condition. We're now outside of the 10 and the 30 period regression channel, testing the bottom quarter of the 90 period as well. So we've really fallen off the highs here in a statistical way. You see the river is actually starting to roll over, as is the dragon, which is leaving the far northern shore and now coming back towards the near side shore. The dragon is this red shaded area. That's the 10 period Bollinger Band plus or minus a half, and which is the front runner for the river. You can see that on Williams percent R, we've come back to oversold conditions. The jaws of PPO warned us back here about a potential turning point in the market, and the jaws remain open and widening to the downside, which is problematic. The last time we saw that was here in mid-March. Market mucked around a little bit, but didn't collapse. The time before that, we saw the jaws opening here, and that led to a sell-off subsequently from about 185 to 173, or about 6%. So a 6% sell-off here from about 190 would take us down. Really, that's about what we're looking at here, is about a 6% to get to 180. But with this still opening to the south, a test of the 200-day moving average is not out of the question here. So the bull market remains intact, but it's very fragile and aging. This predominance of red here into large one-day moves sort of illustrates our reason to be interested in intraday trading as hedges and to take advantage of the large directional days that can occur as counterbalances to the primary trend. And that's what we've had 1, 2, 3 of those in the last 6. Failure below 180 here would be putting the bull market at risk, and then I think it's Katie bar the door down to 173. If 180 fails, I don't really see 176 holding much, and I think 175 then becomes the next target in play. On the upside, we do have distinct profit targets around 184 and then 190. Before I pick up my long side bias, I have to see price up here north of 188 and getting into the green zone. I do have a short-term bias right now. Now that we've breached this zone here at 180 and we've fallen out of the floodplain, I definitely have a short-term short side bias right now as my default condition for intraday trading. On the regional report, 5 of the 10 regions are on cash signals. That puts the theoretical model at 50-50, coming down all the way from 80-20 last week. Bull volatile market for this week. The S&P at 42 is slightly better than the globals of VFA at 41, but it's getting close. Inside the U.S., which are all in yellow, it's large caps, mid caps, tech, and then small caps. Inside the sector spiders, only utilities are showing great strength right now. Even healthcare has started to weaken, now coming down to 42. In the world market model, all of the U.S. is slightly below average. In Asia, Japan is suffering, but interestingly, it's the small cap and emerging markets that are holding up a little better here, I think, as maybe profits get taken in the broad markets. I don't think the emerging markets have enough strength to hold everything up by themselves. I think that's just a one. Those are responses to the large caps in the first world suffering, and I still think we want to be playing defense. Um, China in the red, Malaysia and Singapore below average. Only Indonesia, Vietnam, India showing some strength. In the global sectors, everything is kind of balanced between the U.S. and the globals, with only utilities really showing any kind of strength. And even the former strength leaders in Europe are now below average, with the exception of Belgium, Switzerland, Spain, France. Top 30 symbols using the ETF2 model. I look here at MSCI Frontier 100, being green and white, along with utilities and the international commodity agricultural note from Rogers Internationals. I'm looking for the green and white. You can see just how sharply oil has risen, being green and yellow, as has corn. So really the same trends that we see out of the blended monthly rebalancing. Among the Dow, only 3 in the green right now, with Disney coming off their highs, now are white and green. But Merck, Caterpillar, and Microsoft. And then among the laggards, Home Depot, Nike, Visa, Boeing, and Goldman Sachs. So even the financials getting crushed here. ETF liquidity, just for your reference, these are the top 30 ETFs based on daily dollar volume and the relative volatility that they have. Those in green are exceptionally volatile, and being liquid, they make some good trading candidates. Shifting to the daily report, a ton of symbols on the overreaction and channeling, not surprising. You can see now that the bears are in charge on ADX, and with it below 20, there's room for a long-term trend in either direction to develop, and right now it's pointing the way towards the bears. A number of triple screen and 551W candidates, and a handful on the auto framer that I'll test out better than 2-to-1 reward to risk ratio. Looking at the Dow 30 tactical summary, the pullback always is going to create some favorable reward to risk ratios when testing the 10-day high, and you can now find your favorites, I'm sure, inside here, along with some clear losers from Friday, some clear winners, along with some interesting patterns in channeling, overreaction, 551W, and the triple screen. 5 symbols test out well into RSI2, including JP Morgan and Pfizer. ETF 30 is showing basically the same idea, multiple favorable targets based on the auto framer, only a couple though testing out single digits on RSI2, that being U.S. financials and U.S. real estate. Plenty of channeling and overreaction to choose from. triple screen in consumer staples, and a 551W in S&P Energy. Auto framer for building trade frames based on minimum 2-to-1 ratio when testing the 10-day high. And you can see those listed here. And I'll leave that for your preparation. The market mosaic, see how this rascal has rolled over, has really broken through to the downside. And just now, that selling has been so sharp that just now the exponential or the polynomial regression line is now rolled back to the 30. We've now moved a full standard deviation away from the 6-month normal, as you can see here, and we went negative because it's below the dotted line. You can see the 6-month indication on that chart here. And then this is the price with respect to the 200-day moving average, and we're now 2 standard deviations below the 6-month average and approaching sideways conditions here in about 1.5%. Right, that's everything I wanted to cover for today. For the weekend trading report, this is definitely a critical state developing. Keep your powder dry and your risk measured.